So, you want to understand George Soros? Good luck. Let's talk about the man who's both a legendary investor and a conspiracy theory magnate, George Soros. Before he was a meme, he was one of the most successful investors ever. He's the guy who broke the Bank of England. In 1987, he wrote The Alchemy of Finance, a book that's less get rich quick and more. Here's why everything you learn in economics is wrong. It's about a big idea, reflexivity. Soros argues that markets are shaped by people's beliefs and actions. In markets, our predictions and biases actually change the reality we're trying to predict. Soros says markets aren't rational machines, they're chaotic, emotional, and driven by feedback loops between perception and reality. Understanding his perspective is like taking the red pill for finance. Suddenly, you see the madness for what it is. Let's get to the main event, reflexivity. Reflexivity means our beliefs don't just reflect reality, they shape it. And then that new reality shapes our beliefs. In physics, observing a planet doesn't change its orbit. In finance, if enough people believe a stock will rise, their buying makes it happen. Soros splits this into two parts: the cognitive function, trying to understand the world, and the participating function, acting on beliefs and changing the world. In markets, this happens simultaneously. Investors' actions influence the very prices they're trying to predict. Traditional economics assumes there's a true value out there. Soros says that's a moving target because perceptions are part of the value. If everyone believes a house is worth $1 million, it becomes worth $1 million. There's no stable equilibrium, just constant flux, driven by shifting beliefs. Market prices don't just reflect reality, they help create it. Understanding this feedback loop is the key to how markets really work. If reflexivity is Soros's hero, the villain is the efficient market hypothesis, or EMH. EMH says prices reflect all information, so you can't beat the market. Soros calls this fantasy. Humans aren't rational robots, and perceptions change reality. If prices themselves influence fundamentals, markets can't be efficient. Soros's core idea: we're all biased, emotional, and prone to herd behavior. These errors don't cancel out. They can reinforce each other, creating bubbles and crashes. The market isn't a rational machine, it's a feedback loop, amplifying human error. The real action happens in this equilibrium when perception and reality diverge and fortunes are made or lost. Want to see reflexivity in action? Look at any boom-bust cycle. It starts with a bias, maybe overestimating a new technology. Prices rise, and that perception changes reality. People feel richer, banks lend more, and the cycle feeds itself. The perception of value creates the conditions that justify it. But this can't last forever. Eventually, the gap between reality and perception gets too wide. The bias is exposed, and the trend reverses. The self-reinforcing boom becomes a self-reinforcing bust. Falling prices destroy fundamentals, people spend less, banks stop lending, and the spiral accelerates. This isn't a rational correction, it's an overcorrection driven by the same reflexive forces that created the bubble. Soros's insight: understand the full cycle, and you might ride the boom and get out before the bust. The market's madness is a feature, not a bug. Reflexivity explains why markets overshoot in both directions. That's where the real opportunities and dangers lie. One of the most fascinating parts of the alchemy of finance is Soros's real-time experiment. He didn't just theorize, he traded from 1985 to 1986, journaling his thoughts and bets based on reflexivity. His hedge fund became a laboratory for his ideas. The goal proved reflexivity works in practice, not just theory. Soros constantly formed hypotheses about market biases, acted on them, and adjusted as reality changed. He made mistakes, reversed positions, and showed that flexibility is key. The journal reveals a trader grappling with uncertainty, not a flawless genius. The experiment was a success. He navigated wild markets and made big returns. The lesson: successful investing isn't about a magic formula, but a robust framework and the discipline to adapt. In chaos, mental flexibility is your edge. Soros uses history to show reflexivity at work, like the conglomerate boom of the 1960s. Companies used their high stock prices to buy others, boosting earnings per share through financial engineering. The market's love for conglomerates gave them high valuations, which they used to fuel more acquisitions. This self-reinforcing loop, perception driving action, action validating perception, created growth out of thin air. Fundamentals barely mattered. It was all about the narrative. But when the acquisitions stopped boosting earnings, the story collapsed, the high valuations vanished, and the stocks crashed. The boom turned to bust, a textbook reflexive cycle. Perception created value, then destroyed it. Financial alchemy, for better or worse. Another case study: the Reagan era imperial circle. Reagan's tax cuts and military spending led to big deficits, financed by attracting foreign capital with high interest rates. This made the dollar soar, which kept inflation low and fueled a stock market boom. The strong economy and market justified the strong dollar, attracting even more capital, a reflexive loop. Soros saw this as a bubble, the US, living beyond its means, sustained by global money. He predicted the cycle would break when the trade deficit became unsustainable. In 1985, the Plaza Accord devalued the dollar, breaking the loop. Soros, positioned for this, made a fortune. The lesson: reflexivity operates on a global scale, not just in stocks. Perception and policy can create and destroy economic realities. Spotting the flaw in the loop is where the money is. So, what should you take away from all this? First, embrace humility. The market isn't logical, and neither are you. Acknowledge your own biases, and the market's. Second, think in feedback loops. How does perception affect reality? And vice versa. Look for self-reinforcing narratives and identify when they're about to break. Third, love disequilibrium. Real money is made in times of instability, not calm. Be a contrarian, but with a solid thesis about why the trend is unsustainable. Finally, be flexible. Soros constantly tested his ideas and changed his mind when facts changed. No ego, just hypotheses to be tested. When the market proves you wrong, adapt. Don't double down out of pride. Accept feedback, learn, and move on. That's the real alchemy. It's 2025. The market is faster, more global, and more chaotic than ever. So, does a dense book from the 1980s still matter? Absolutely. The alchemy of finance is more relevant now. Markets are still driven by human psychology, and that hasn't changed. Social media and instant news have put reflexivity on steroids. Feedback loops form in hours, not months. Meme stocks and crypto are perfect examples. Narratives drive prices, which reinforce the narratives. Understanding reflexivity is now a survival skill. The 2008 crisis proved mainstream models, wrong regulators, missed the reflexive housing bubble. Soros' framework helps spot systemic risks and irrational cycles. For finance students, this book is an antidote to textbook oversimplification. It's a call to think critically and recognize the messy role of human behavior. No easy answers, just a better mental model for chaos. In a volatile world, these ideas are essential. You're going to need them